I don't believe in diversification at all. I would own one stock. Diversification is a big mistake.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance.
In an interview, Mark Cuban once said, "Diversification is for idiots." Sure, he probably only chose those harsh words for the catchy headlines, but the underlying sentiment remains. The self-made billionaire star of Shark Tank is not alone. Diversification is for people who don't know what they're doing, according to Warren Buffett.
This isn't portfolio balancing you're talking about.
No, all that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
As for Buffett's right-hand man, Charlie Munger, he also uses unmistakable words when speaking of the failures of diversification as an investment strategy to beat the stock market. Quote, "An idiot could diversify a portfolio." In this case, he was referring to money managers who charge clients 2% management fees to only get them 5% returns as the result of their overly diversified portfolios. In case you're new to all of this, 5% returns, even 10% when you're poor, is awful. This is what diversification offers. Even the living legend Peter Lynch, who achieved 29% annualized returns over 13 years in his Fidelity fund, is staunchly against the fallacy that is diversification as a winning investment strategy. In his own words, diversification is a big mistake. I call it diversification. You buy this thing to balance this other thing, and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories and they're all equally attractive, I'm buying all 10.
And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%, so you sell 7 and buy 2. That's all I do.
Surely, all these highly successful investors haven't conspired against diversification. So what's wrong with diversification? Why is this such a bad idea for those who want to build outsized wealth and to actually retire comfortably and even early? I have explained this in all of my previous portfolio update videos, so if you haven't seen those, definitely go check them out. At those times, I had between 7 and 12 stocks. This year, I've doubled down on my strategy of hyper concentration by bringing my number of companies in my growth portfolio down to just 5. I'm highly confident in these 5, each from different industries I'm passionate about and knowledgeable in. I have electric vehicles, electric vehicle infrastructure, e-commerce platforms and the infrastructure they run on, financial services and their infrastructure, and web security, and again, the infrastructure for the internet. Most people might hear this and think it's highly risky, but in this video I'm going to walk you through exactly why the opposite is true. As we explore the shortcomings of diversification, if you're interested in seeing my highly concentrated portfolio that has helped me 10x my money over the last 2 years, don't forget to like this video, subscribe to the channel, and comment your thoughts and what you'd like me to cover in the next videos. Although this video is highly opinionated, remember to always think for yourself. As we'll discuss, these strategies are not well suited for everyone. A highly diversified portfolio may be right for you at this time in your wealth journey, or it may not be. What matters is that you have a good understanding of your options and make an educated decision on how you approach wealth building. As always, realize that there are 2 distinct stages in the wealth journey: wealth building and then wealth maintenance. More diversification is better suited for those who are in the second stage with meaningful wealth to maintain. These people are usually those who successfully navigated the first stage to build outsized wealth, which allowed them to enter comfortable retirement. Before I explain why a highly diversified portfolio is a bad strategy for investors who are on the wealth building stage, as I have many times on this channel, here is one more quote from Warren Buffett to tee us up.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Ignorance in this sense is defined as lacking knowledge, information, or awareness about a particular thing. So yes, diversification is a protection against ignorance. That doesn't mean that those who diversify are unintelligent. What it generally means is they don't have the time or desire to do the work to gain the necessary knowledge on individual companies in the market. They don't have the energy to seek out the best long-term opportunities and continue tracking the progress of those businesses over the years. However, they are aware of the need to be invested in the market one way or another in order to build some amount of wealth beyond their basic savings account. With that, they decide that it's safest to just bet on the entire market rather than trying to become knowledgeable about specific companies and industries. In effect, they are protecting themselves against their own ignorance. That's perfectly fine. For most people, this is the best strategy. Why? Because most people will fail at picking their own investments. Why? Because once more, most people either don't have the bandwidth or the desire to do the work it takes to find great companies and inspect whether they have great management with great long-term upside potential. Most people just don't want to do the work. Again, that's fine, but what it doesn't mean is that diversification is the best strategy. It's just the easiest. One thing I know to be true about easy things is they attract lazy people. Lazy meaning unwilling to do work or use energy. And we've already examined how this applies to most people and their approach to investments. That includes the fund managers. Counter to popular belief, they are also lazy. When you choose diversification, you admit to yourself that you are unwilling to do the work of researching and tracking a select few businesses. That may just be your choice not to use your limited energy in that way. You might not care to build outsized wealth. Your goal may be as simple as building a non-insignificant amount of wealth that will allow you to at least cut back on your working hours in your old age, or even stop working altogether to live a very modest lifestyle. Again, that's fine, but once more, that does not negate the fact that diversification yields mediocre returns. When you invest in a wide basket of things, what you get is a wide basket of returns. In that basket will be a distribution of good, average, and bad returns. When you examine that average, you'll notice that it doesn't resemble the good nor bad returns. What it is, in fact, is a mixture of both. And because most businesses underperform, that average will more closely resemble the bad returns. Consequently, what that average is, unfortunately, is mediocre when compared to a highly curated basket that contains mostly good businesses and a minority of businesses that just didn't work out as expected. Due to math, your basket that contains all the top, middle, and bottom businesses will have its average dragged down to around the middle at best. Those who choose concentration will instead opt for filling their basket with only the few companies they believe have the best chance at success. Then, they will invest all their resources into ensuring that that basket continues to only contain the best companies. As time passes, they will curate their basket even further. As they see some of their companies outperforming, they may shift more of their resources to those companies in order to lift the average return of the basket.
So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories, and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage. So that either happens because something happens to the company, or the market goes down and all stocks go down.
As for those businesses that underperform, the concentrated investor may decide to completely remove them from their basket to dedicate more focus on the remaining businesses they believe have the best long-term potential to raise the average return of their basket. Sure, they may make some errors in their judgment here and there, but they will act in accordance with principles they developed from life and studying the successes and failures of those who preceded them. They will have a criteria for choosing the companies that are added and a complementary criteria for expelling the ones that fail to keep up with the character of the basket. With only a few companies to look after, they will be able to do high quality ongoing research into the fundamentals of each asset. They will have time to examine the management team, the balance sheet, and reconcile all the qualitative metrics with the quantitative ones to determine the chances of the long-term success story playing out as desired.
You can't diversify enough to know what you're doing, right? I mean, I did my homework on Australia, right? I did my homework on the Emrys. I did my homework on MLPs.
If they have 10 companies in their basket, they can dedicate 10% of their active time or 11 hours a week to tracking one of their assets. Better yet, if they have only 5 assets to look after, they will have 2 days to spare in each week. Contrast that with someone who chooses a diversified basket of 50 companies. This poor soul will only have 2.5 hours to commit to each business. If that doesn't sound bad enough, they will also have the impossible task of remembering an adequate amount of the information they try to acquire on 50 different businesses. When you invest in a business, you're engaging in one of the most intimate relationships you can have because your financial stability is tied up with it. In modern society, if your finances fail, it's likely that you will soon fail. Given that, it's critical that you maintain a close hold of your investment relationships. According to anthropologist Robin Dunbar, human brains have a limit on how many meaningful relationships they can keep track of. Dunbar says most people can have up to 5 intimate bonds, spouses, best friends, and so on, and 15 close friends, people you trust and spend time with regularly. That's 20, and realistically speaking, you're only likely to have 7 close relationships in your life. To ensure each of these relationships are of the highest quality, concentration is essential. The same goes for your investment relationships. The investor who only needs to manage 10, 7, or even 3 investment relationships has a far better chance at financial success than the investor who opts for a far larger basket. The diversified investor might have many relationships to fall back on if one of them fails, but because of this very fact, the bonds will never truly be strong. Consequently, these weak bonds have a greater chance of breaking, of failing. In the end, some of these bonds will fail, some will hold on enough to survive, and a few will approach elevated strength. Nonetheless, when we examine the average quality of these relationships, we'll see that because you never really had enough time to dedicate to building up each one, the average quality of your relationships is just okay. You're not alone, but your remaining relationships aren't that strong. They don't bear much fruit. In the other lane, we have the concentrated investor who gives each of his relationships adequate time and resources to mature. This investor may even have enough time left over to do something extra to benefit their top relationships. They can remember each person's name, family makeup, career development, financial situation, and long-term goals. Their bonds are strong and unlikely to break. Sure, this concentrated investor has a smaller set of relationships, but the focus on each one will give them a better chance of working out. What's more, if one of the relationships isn't working out due to fading compatibility, the concentrated investor will notice it early so they can end that relationship and dedicate more time to the remaining basket. When we go to examine the average quality of the bonds in this concentrated basket of relationships, we'll see that although a few may be weak, the ones that remain are unusually strong. Given the choice and adequate time, I'd bet that most people would truly rather have the concentrated basket. Unfortunately, most people realize the trade-off here is they'll have to put in more work to maintain their few relationships as they won't have many to fall back on. Given this perceived risk, in reality, most people, when initially presented the choice, would choose the basket of more relationships to protect against ending up alone. Paradoxically, the odds of feeling alone, as with those of realizing mediocre returns, is directly proportional to the increase in weak bonds. thank you for watching this video. If you enjoyed it, do me a big favor, like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. Let me know if you're diversifying or if you're concentrating on a few companies. And if you disagree with what I've said, let me know. Let's discuss. And of course, as always, these videos are brought to you by our patrons at patreon.boacademy.org who support the channel financially and help us keep going by helping me brainstorm new video ideas to show all of you. So if you'd like to support the channel financially and get more access to me and get direct answers to your investment questions, then join us over at patreon.boacademy.org, where you'll get to discuss the stock market in real time every day with us in our Discord channel, where we share news, rumors, and investment ideas so we can all do our own research and then come back together and collaborate. So if you're interested in all of that, I hope to see you over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again and have a great day.